Yeah, that's right. Negative interest rates are now on the table, and this is just another big screw waiting for you from government, primarily the central banks, but matches the insanity that's going on with our national governments everywhere. But what exactly are negative interest rates? So with that, there's going to be two parts. One is the theoretical part. One is going to be the reality. And of course, both of those are completely different than the other. So there's the theory of the negative interest rates. First, what is a negative interest rate? Well, it literally is just that. It seems counterintuitive because, well, it kind of is. But just like a regular interest rate where you would pay a certain amount if you borrowed some money from the bank, or if you had a savings account or an interest-bearing checking account, if you kept $100 in there and you had 2% interest rate on a checking or savings account, well, every year, if we just keep it simple on an annual basis, you'll get another $2 if you didn't touch the balance. If it's a negative 2 interest rate, well, at the end of that year, instead of having $102, you'll have $98. So what is this all about? Basically, this is the central bank going yet beyond what would normally be in the past, something that they would never think to do. But this is how extreme our central banks are and our federal governments are with all the spending and all the deals that are going on. But what's going to happen if we do the negative interest rates from the central bank? Well, there's a couple of things that they're trying supposedly to do. One is to spur dealer and commercial bank lending rates. So the central bank has the interest rate that it sets on its loans to the large commercial and dealer bank institutions, and from there they tack on additional point basis when they lend out to the end consumers, such as ourselves, or even larger institutions or businesses that need to borrow for their own spending. But it's basically the first part of the food chain of the interest rate that gets passed on, because they're the middlemen. So with that, if we have a negative interest rates, the money that's being held at the Fed for and on behalf of dealer banks and large commercial banks, if there's a negative interest rate, just like I told you before, you wouldn't want to keep your money in the storage if you're actually losing money in the bank. But, well, that's the theory. Now, of course, at an institutional level, it's a lot more complex than that compared to a regular consumer such as ourselves as individuals. But the point here is to try and influence / force the dealer banks and commercial banks to not hold on to this money, because it's literally going to cost them money for not doing anything with it. So there's a point here where the expectation is that down that middleman line of lending and products and services that they provide, that they will be forced, maybe force is a little influenced, to help push out the lending. And because ultimately, why are we doing negative interest rates? The main parts of doing negative interest rates is to try and spur the economy and really the velocity of spending, which is excuse me, is all types of spending, and to help spur some growth. And what is definitely also wanted right now is inflation, to help with all the QE spending that's been going on. That's a topic for a different video, but there is a big double whammy here. But that's part of the main reason for having that come about. The other part here is to spur consumer spending. How this exactly affects down at the consumer level does depend on the country and the different banks. So, for example, negative interest rates can be put in by the central bank of a country, and for different various reasons, they might not actually reflect in negative interest rates in your savings accounts or in checking accounts. Or there's this theoretical belief that if you borrow money, instead of paying interest, you'll receive interest. Well, that's never going to happen, obviously. But the point here is at some point it can go that far, and has in the past in some countries, where you won't have the ability to keep your money in storage with the bank without actually being forced a fee, in essence, a storage fee. And with that, just as it was at the commercial or dealer bank level, is to try and get you to spend your money and spur growth, spur inflation, which it's a bit counterintuitive to me, but from their point of view, they think they have that where it makes sense. So what is the reality of negative interest rates? Well, for one, at the consumer level, you're going to realize that you're going to get punished and have to pay more than you already do, especially if you're in one of the big banks having savings accounts or checking accounts right now. Many of you know, depending on the large commercial banks, will require some banks like Wells Fargo for some premium checking will require at least $25,000 in assets with them in order to have just free checking. Other ones could be $3,000-$5,000 minimum, unless you go, and I encourage you to try out some smaller local community banks, or particularly savings and loans. Savings and loans are really one of the best places for the average consumer to get a friendlier service, one that makes you a bit part of the bank itself, or savings and loan. Technically, it's not a bank. Technically, there is a difference between the two. You can also create a relationship that has a little bit more flexibility with a local savings and loan. And they very often have very low fees, and then a lot of free checking and a lot of other free services. And you're actually keeping your money local. So that's something to keep in mind. But if you're having negative interest rates in a checking account, well, take a guess what's going to happen for a certain number of people. We're going to want to pull your money out. So while one of the beliefs here is at two levels from the Fed to create and stimulus and force lending out at the big commercial bank level, but also its hope is to drive some spending at the regular consumer level. And if people are already feeling the pinch from the whole pandemic and the lockdown, do you think they're going to be even more happier now to be pushed out of the bank with their money and say, oh, well, I'm just going to go spend it while I never know what's going to happen while there's more lockdowns? I mean, obviously that's not going to happen. It's silly. It's stupid to even think that way, but that's one part of it. Consumers will look for alternative storage. Well, first of all, there's no way I wouldn't keep my money in the bank if they're going to start charging me any fees. I've seen fees accidentally for some of my accounts when they might have dropped below a certain amount where they wanted $30 a month. Okay, I mean, with Wells Fargo, you could have $10,000 in cash in one of their premium accounts and still be charged $30 a month. I'm not going to do that, and I know I'm not alone. So what's going to happen? You're going to look for alternative places to keep your money, which is, first of all, one of them is at least switch banks, because there's a good chance that not all of them would enact such a policy. And you can find some alternative, and other alternatives would be to pull your money out. Other ones would be to invest them in other different vehicles if you had a large amount of money and you weren't going to pull that out and stuff that under the mattress. Again, the reality here is all this belief that they're going to put pressure on the commercial banks and the dealer banks on forcing their hand again to create more loans consumer loans, business loans than they normally would. And that presents a lot of different problems here. Number one, their individual corporate strategies and goals are being subjugated here by the Fed, because the Fed's only goal is to try and spur some inflation and some spending at the same time. And this way, they're actually undoing some influence at the individual corporate level. And this is, there's clearly something wrong with this. It's trying to manipulate what their goals might be in terms of what their own corporate policy and investing plans have been for short term and long term. Other thing is if they wind up spending or lending out more, well, they still, yes, they have their loan reserves that they need to keep, but it's forcing them a bit against their will to take bigger risks. And this is part of what we saw in 12 years ago in 2008 and the years leading up to that. Of course, on that point, it was about greed and just the markets just going absolutely crazy. Well, this could be sort of have the same effect, but from a different point of view, where they might have a certain amount of losses just by having their reserves held, and without having their reserves held without a fee, they can be influenced again to make or stretch out their lending guidelines to put themselves in a point where they're riskier than where they would have been. And that's the last thing that's needed in these lockdown times. The other thing here in the lastly would be that some government bonds can actually go into no yield status, where commercial and larger banks holding on to significant amount of government bonds can actually wind up paying, instead of receiving some interest, and the interest obviously is very low right now, actually wind up paying the Fed, paying the government for actually giving them money to lend. Now, I mean, that's just completely counterintuitive, but this is also a bit of what I call a reverse tax. It's by loss of these investments. I mean, we're talking billions and billions of dollars that are invested into these government debts, and if they go negative, well, those are definitely going to have to be paid. So you'll be paying for the risk of owning government debt bonds with a government and a Fed that's outrageously spending, creating stimulus plans, and now the expectations are all that these stimulus plans just need to keep going. And this is going on throughout the entire world now. So we're in a territory that we've never been before. And that's why negative interest rates, which never really have been considered for a long time, the fact that they're being considered along with everything else just shows that you're in times of really getting screwed here, and you need to start planning ahead, which we will do in another video on what can you do when the banks and the government are going this far out of control and you have no place to even park or even save your money. So they're encouraging you to not save your money when we already have 80% or higher of our population here in the U.S. who, before the lockdowns, were living paycheck to paycheck. And now the situation is even more precarious, and they can care less about you. So you need to watch yourself, and you need to come up with a plan for being able to save off some money and anticipate that this whole thing, this whole charade's all coming down.